would say the global economy is still decelerating. You're seeing this continued slowdown. We think a recession is on the horizon. It could start as early as the fourth quarter. If the Fed right now is projecting that we're going to go from a 3.5% unemployment rate today to maybe a 4% rate in 6 or 9 months, it's not going to just stop at 4% if they're correct. It's heading to 5 or 6. And that means there's going to be other effects happening in the economy if you see that many more people lose jobs.
Welcome to Wealthion. I'm Wealthion founder Adam Taggart. As the market struggles to find momentum here, the question investors are wrestling with right now is, will the rally resume, or might it be time to get out of the pool? Oxbow Advisors is a financial advisory firm that specializes in the needs of high net worth clients. I spoke a few weeks back with its founder and CEO, Ted Oakley. Today, we've got the good fortune of sitting down with Chance Finucane, Oxbow's Chief Investment Officer, to learn more about what the firm sees ahead for the rest of the year and how it's positioning its clients' assets for it. Chance, thanks so much for joining us today.
Hi, Adam. Thanks a lot for having me on the show.
Oh, it's a real pleasure. Like I said, we've had Ted on the program a couple of times, but this is your first appearance. Really nice to have you on. Welcome. A lot of questions here for you. I know you're the guy, you're where the rubber meets the road there at Oxbow, right? You're the guy who's actually making the big decisions, coming up with a portfolio strategy. Want to get into kind of all the things that you're doing right now, but if we can, let's just kick things off at a really high level. What's your current assessment of the global economy and financial markets?
We'd say the global economy is still decelerating. You're seeing this continued slowdown. We think a recession is on the horizon. It could start as early as the fourth quarter, and really not seeing anything that changes our view on that, with central banks around the world continuing to be pretty restrictive in their policy and seeing more and more leading data points that suggest that the final outcome of this cycle will be a recession. And then in terms of the financial markets, outside of a couple of countries like maybe Japan and India that you're seeing some acceleration and some good performance in their equity markets, the other stock markets around the world, whether it's Europe or China, or starting to see the US show a little bit of a plateau here after rising in the first half of the year, we would say it looks concerning. And for us, we've been defensive for more than a year now. And I think we're going to continue to have that stance while we try to be very prudent with any additional allocations we make across riskier assets.
Okay. A lot of places I want to take this. Because you mentioned recession a couple of times, let me just ask you this question, because I've been asking it of a number of recent guests. Coming into 2023, at the end of 2022, recession looked all but inevitable. And then it didn't arrive, right? And we had this big run up in the markets for reasons we can talk about in a bit if you like. But I'd just love to get your 2 cents on why do you think the recession didn't arrive when so many people think it did? And then if you can tie into why you're more confident that it's going to happen on the timeline you just mentioned.
Yeah, I think it depends on which leading indicators you were looking at. So there were some leading indicators that suggested that sometime, even in the first half of 2023, a recession would really start to take hold. But there are other indicators, whether it's the time it takes on average from the first rate hike by the Federal Reserve before a recession starts, which on average is 22 months, just shows how long that lag is before changes in monetary policy really start to shift through and affect business decisions and household decisions. You can also look at when there's an inversion in the yield curve, whether you're comparing the 2-year Treasury yield versus the 10-year yield, or the 3-month versus 10-year. When those rates invert and you've actually got a higher yield at the shorter end of the curve rather than the long end, that still takes a long time, more than a year, for a recession to usually take hold. So if you're looking at it from that perspective, I think we've just gotten used to expecting something to happen very quickly, when normally this can take 18 or 24 months to play out before you really start to see a typical economic slowdown and then deterioration.
Okay, and do you think it's more than that, which is just, hey, these things just take longer than most people expect or were expecting at the turn of the year? Or do you think it's influenced by, while we have the Fed pumping hard on the monetary brakes right now. On the fiscal side, they're still very much stamping on the gas with the deficit spending that's happening right now. I've had some people posit that the high degree of deficit spending that we've been doing this year has actually kind of pushed the recession off into the future. And maybe it's a combination of the two. I don't know. What do you think?
We'd agree. I think everyone was a bit surprised seeing that government spending number be as high as it was in the first half of this year. If you're looking at the breakdown of the components of GDP growth. And when we look at that, we actually think that's going to make for a difficult comparison in the first half of next year. So even though this third quarter GDP growth number that we're in right now probably be pretty good, somewhere between 2 and 3%, we would expect that to start to really slow down in the fourth quarter and then in the first half of next year. And unless they're going to continue that sort of deficit spending on the fiscal side, it's going to be difficult to keep up that same growth rate heading through spring of 2024.
Okay. And you just mentioned maybe GDP growth of 2 to 3% in Q3. Right now, if we total over to Atlanta Fed's GDP Now page, on the day we're recording, I think it's still somewhere up around 5.8, 5.9%. So it sounds like you expect that number to come down pretty substantially as we get further into the quarter.
Yeah, we do. They've had numbers projected that high in the middle of a quarter in the past. Last time that happened, it ended up being a 2% GDP growth rate for that quarter. So what they do is they're pulling numbers as data points come in, and they've really only got 1 month out of the 3 for the third quarter to go off of so far. And the housing component is such a significant component that when you have a beat in housing numbers like we had in July, that shifts their expectations higher. But they typically have been over optimistic, and then you see the number come down. So we wouldn't expect that 5 or 6% annualized projection to actually come through.
Okay, yeah, because I think some people would say, well, Chance, if you think that a recession's coming and maybe could even hit at some point in Q4, that doesn't seem to comport with an almost 6% GDP growth in a quarter. And what I hear you saying is, yeah, I don't think we're going to have near 6% growth. I think it's going to be a fraction of that, probably, at least half, if not less.
Yeah, that's right. It'll still, we would expect it to be a positive number, just given what we've seen so far. But one thing for people to realize is you can go back and look at the start of recessions going all the way back to the 1960s. And if you look at the quarter before the start of the recession, very often you see an annualized GDP growth number in that final quarter of about 2 to 3% growth. So you'll see numbers still look good right up until the point that they don't on that GDP line. So that's not something to say that, like, for instance, if the third quarter does come in at 2 or 3%, that, oh, everything's fine. And anyone who thinks that a fourth quarter or first half next year negative GDP, that they have nothing to go off of.
Okay. So you mentioned that more and more of the leading data that you're looking at looks recessionary. I'd love to get a sense of what leading indicators you're looking at most closely right now that are kind of giving you confidence in that. And to kind of kick off your answer, if we could talk, it's not an indicator, but it's a milestone that's coming up here, which is student loans going into repayment. So barring some sort of 11th hour reprieve that comes out of DC, it does look like 40 million borrowers are going to have their loans start going into repayment in the next 30 days, right? I think they start accruing interest again as of September 1st, and the first payments have to start arriving by the beginning of October. If I'm doing my math right, I think it's about, on average, something like $300 per borrower per month. And so, that adds up pretty quickly over 40 million borrowers. That's money that has been going into the economy for the most part. I think in the vast cases, those people have not been squirreling that money away. They've actually been spending it on consumption. All of a sudden that comes out. So how big of an impact do you expect that to have on the economy?
For the student loans, we wouldn't expect it to be a huge impact for those 40 million households that are going to have to resume paying student loans. I think I've seen sort of like a low, maybe even mid-single digit impact on their spending for that portion of U.S. households. But I think when you include that along with the mosaic of just all of these sort of life decisions that with a higher interest rate environment, people, it may not affect them right away if they don't have to buy a new house or buy a new car or resume the student loans. But over time, the longer that the Federal Reserve keeps rates this high, eventually people are going to have to start making decisions that they are going to feel that impact of higher rates. And that's where you could see a really significant jump in their expense base, and then they have to pull back. And one thing that we keep track of is the amount of money going towards discretionary good spending versus non-discretionary. And from 2020 and 2021, there was definitely a more exaggerated focus on the discretionary spending side, which makes sense when people weren't traveling as much and you had a little bit more excess savings to spend on goods. But since early 2022, it's shifted more and more to non-discretionary, which tells us that the impact of higher expenses, that inflation that is still impacting people, and then you start throwing in things like the student loans, it's only going to add more and more towards people just having to spend on what they really need and pulling back on everything else.
All right. And imagine if you combine that with savings rate now having plummeted, consumer debt balances, revolving credit balances like credit cards and stuff like that back at record highs. Those are, I guess I would say, concomitant signs of a consumer that's continuing to struggle, having to fund more and more of their consumption on credit. And it sounds like they're mostly now using that to buy essentials, not frivolities like they were during COVID.
Yeah, there's a couple different ways you can look at recent data points to confirm that. So first, your point about credit card usage, David Rosenberg recently pointed out a stat that they sometimes will post quarterly changes in credit card delinquency rate. And the delinquency rate on bank given out credit cards, those now have hit a delinquency rate that last was seen in 2012. But the difference is in 2012, the unemployment rate was still 8% compared to a 3.5% unemployment rate today. So you're not even factoring in that people are going delinquent on their credit card bills because they lost a job. This is just higher expenses and not being able to keep up. Another area that you're able to look at is we've seen a lot of retailers report their quarterly earnings in the last couple of weeks. And there's been a very significant difference between more staples-oriented retailers like Walmart still reporting good numbers. And then you saw what happened with more discretionary retailers like Macy's or Dick's Sporting Goods that are seeing a significant pullback in spending and more delinquencies on the credit cards that they issue.
Interesting. In the case of Dick's Sporting Goods too, I know that part of their underperformance was due to theft, right? Which is due to sort of the rampant shoplifting that's been going on across the country. And I think that in itself is a sign of a struggling consumer, right? Where people get to the point where they just feel like the only way that they're going to get by is to go in and grab things off shelves and run, right?
Yeah, sure.
Your point too about we're seeing elevated delinquencies at levels that were commensurate in the past with high unemployment, right? Which makes sense. People don't have jobs they can't pay, right? Don't have income they can't pay. You can make a really direct analogy to the federal deficit right now, right? Where we basically are, said many times in this program recently, we're running essentially a wartime deficit in terms of its percent of GDP in a peacetime economy where we have unemployment. We've never put it this way: we've never run a deficit this high as a percent of GDP with an unemployment rate this low, right? So it just says both at the individual household level and at the national level, we're struggling to make ends meet even during quote unquote good times, right? So it does raise the specter, if you're correct about a recession arriving, is like, wow, what are we going to be doing when times are tough, right?
Yeah, absolutely. And we think about this a lot because we're always trying to consider the incentives or the motives of the key players involved, whether it's the Federal Reserve or the US government. And I think the number one focus for Jay Powell at the Federal Reserve is bringing down inflation. And we think people are underestimating just how long he might keep interest rates high to really try and make sure that the inflation rate can get down to 2% or below. But what he also needs to have happen is there's enough of a slowdown and potentially a recession that he can feel confident that he can lower rates back to a more normal level, say 2 or 2.5% on the Fed funds rate, so that those interest expenses on the US Treasury debt is not going to be annualizing at a $1 trillion rate like what we're starting to look at we'll be paying going forward. That's not something that fits with the overall fiscal equation for the United States. They can't keep rates this high, so they really need to slow things down so they can cut the rates, but they got to get inflation down first. So it's sort of a domino effect, but we do think that's why he will keep rates high for as long as possible to make sure that things have really come back down to what he would consider to be a normal level.
Okay, so let's talk about inflation and interest rates then. So, you know, inflation's come down a fair amount from its highs from last year, right? We've come down from 9% to 3%. We're seeing it begin to bump back up again, and to a certain extent that was expected with just the math of base effects. But also, I have had some recent discussions with folks on this channel about how the remaining inflation may prove stickier and harder to remove than the progress we've made so far to date, right? And it's been posited sort of like the Pareto principle. 20% of the effort is expended to get rid of the first 80% of inflation, but the real the majority of the effort now is going to be spent getting it down from 3 to 2, right? And there have been people that have been saying, and there's been a lot of trial balloons recently floated, well, maybe the Fed will just raise, right, its inflation target to 3%, and it can say, oh, well, job done, right? But Powell seemed to really directly address that last week and said, our goal is 2%. We are not wavering from that. We are going to be as higher for longer until we get inflation down to 2%. How successful do you think the Fed is going to be with inflation? Is it going to have still more of a wrestling match ahead of it? Or, some people are saying the dragon's been killed. It's just all over but the crying, and with forces of disinflation and deflation and arriving recession, inflation is going to be cured anyways. What do you think?
Yeah, so first, we don't think that he's going to move the target and say that 3% inflation is the new goal for the average. We think he's very focused on maintaining the credibility of the Federal Reserve as an institution, and he knows that they have to get it back down to 2% or below just to show that they're still capable of doing that. But to your point, we would agree with some of the previous people you've had on your show that it's going to be difficult to get from the current 3% level down to 2%. We would actually say, like others have, that we're going to be drifting a little bit higher, and that you're probably going to be between 3 and 3.5% for several more quarters. And until you start to see more parts of the economy deteriorate, some of that probably related to jobs and wage growth coming down, it's going to be difficult to really see that trajectory from 9% down to 2 or below be completed. And that's why when we look at we're looking at what the market's reacting to today, where you've got the new JOLTS job openings number comes out lower than expected. Conference board expectations numbers are lower than expected. And people are thinking, oh, that's great. That means there'll be no more rate hikes. They'll start cutting rates in May of next year, and we'll kind of get this perfect sort of economy and market that we want. We don't think that's how he wants this to play out. He really wants to keep rates high for as long as is necessary to achieve that 2% goal. We just think it's going to take a while, and it's really going to test how committed he is to achieving it.
All right. So the ways in which that Powell can continue to fight inflation is he can keep rates higher for longer and just wait for the lag effect to continue to fully arise and bring things down. Of course, he could add more fuel to the fire, and he could continue to hike rates from here. You mentioned 3 to 3.5% inflation for quarters, right, with an S. So I guess first question is how likely do you think it is that federal funds rate could go even higher from here?
It's possible. We don't usually try and say for certainty, oh, it's going to move higher. I think the key is just that it's going to be at this level or even a little bit above it for at least several more quarters. And if that's the case, that just allows more and more time for that sort of quantitative tightening, whether it's the actual QT that's happening or the restrictive rates, to slow down economic activity. And it leaves more time also for any sort of exogenous shock that could happen in the economy that would send the market and the economy into a recession. I think that's where we're focused, is just, I think one thing maybe just to pull back is, rather than thinking so much about, is this going to imminently happen, it's more thinking about what is the inevitable outcome. And the way that we think he is currently playing his hand is that the inevitable outcome will be a recession, and it pays to really be defensive and thoughtful in terms of how you allocate assets. And that's sort of the approach that we want to always maintain until we see the conditions change.
Great. And that's where I'm going, by the way. We are heading towards the how are you allocating assets question. When we talk about these higher rates in QT, but particularly the rates, the analogy I use is it's almost like the Fed is dialing up the pull of the force of gravity on the economy, right? It's like being on a planet where the gravitational force is just higher than it is here, right? So it's just harder for the economy to move forward. It just moves more slowly. And when you were talking about consumer households earlier and saying, look, the loan repayment in and of itself isn't a massive deal, but given that it's just one of many injuries that the consumer household is having to endure right now, it could be that straw that breaks the back for a number of them, right? And so when the gravitational force is this heavy, yeah, anything that adds an additional stone to its back, just pulls down with that much greater force. And of course, everybody's sort of concern here is that the U.S. economy got habituated, addicted, if you will, to ZIRP, to historically low interest rates. And we're now up here at 5.25 plus, maybe even higher, who knows, right? How long can it move under that force of gravity before things really snap and break? And of course, I think a lot of the pivoters think, hey, I'm excited when there's bad news, like the JOLTS report, because I think something's breaking and the Fed's going to have to step in and rescue. Powell obviously is saying, I'm going to keep flying this plane at this altitude until inflation gets where I need it to be. How do you see this resolving? Because the longer we hang out here, if we hang out here at quarters at this amount and inflation, persists the way that you think, the odds of more and more stuff really breaking, it increases pretty substantially. Will Powell let it break and let the hemorrhaging happen if inflation is still stubbornly above his target here?
We think the two are pretty much tied together. In order to see inflation clearly get to 2% or below, it usually means that something does break, because in the past, recessions, even in a more inflationary environment, you will see inflation come down. You'll see long-term bond yields come down. So we would actually expect the two to be somewhat linked. And that will be the way that he gets inflation back to his target, and would then give him the ability to lower rates after he says that his job is complete. But for that to happen, you'll likely have seen the prices of assets in the financial market come down significantly. And I think that's probably the thing that's most interesting to us is on days like today, where the market is trading higher after the JOLTS job openings data comes out, people are taking bad news as good news. There's cases of this in the past where when the Fed first started cutting rates in the early part of the great financial crisis, you would see stock prices move up in the short term. But if you are heading towards a bad economic environment, eventually that bad economic data takes over and you will see share prices fall. So we wouldn't get caught trying to chase any move higher here at these prices. We think it's much more to be focused on where the end outcome is in this cycle.
Okay, yeah, and I'm always, this is why I hammer on the lag effect so much, and feel free to agree or disagree with me here, but so many of the people that are, again, hoping for the pivot, that are cheering today's bad JOLTS data, as you mentioned, in their minds, they think, okay, great, the Fed's going to have to pivot soon. And then when the Fed pivots and rates start coming down, then it's back to the old salad days, and prices are just going to shoot the moon as a result, because that's what we're used to. But if you go back and you look at every other period of time where the Fed has hiked rates until really things started to start breaking, really when the Fed pivoted, you then were followed by quarters of pain and declining financial asset prices. And the thing to keep in mind with this is that the lag effect is it's a bolus of things that move as like a big bell curve over time, right? Which is why, to your point, even though the Fed really started, its tightening efforts well over a year and a half ago, we still haven't really seen the full force of that yet because it takes a while to go through the economy. Well, it's the same thing when you cut, right? When you cut, you're cutting because things look bad. Well, you're just beginning to see the real mass of the prior policy, right? And that has to play out through the system. And then at some lag of maybe a year and a half plus, whatever, then the policy shift begins to get reflected. But that's way in the future here, right? So, I think people just have this really erroneous, maybe magical thinking right now that the lag effect doesn't matter from all the tightening stuff, right? So we don't have to bring down asset prices like stocks or housing, right? And then secondly, that if and when the Fed does pivot, we're going to magically go back tomorrow to the happy days, where it's like, no, you're going to be in probably for a world of pain for a good while.
Yeah, I think it's a great point that the Fed moves on lagging data. They're not going to try to be predictive, even if they see something that suggests that, let's say they thought inflation was going to come in really low. They can't move ahead of that and start cutting rates when the headline inflation number is above their target, because most of the country is going to think, what are you doing that for? So they're always going to be a little bit late. And by the time they would move, like you said, things are usually already breaking. But once that momentum on the negative side has started, it's very difficult to just stop it on a dime, even with the Fed trying to take what actions they can. And the best example of that would be to look at changes in the unemployment rate through a recession. And once you see the unemployment rate rise by 0.5%, it usually means that it's going to rise by at least 1.5%, if not 2% or more in total. So if the Fed right now is projecting that we're going to go from a 3.5% unemployment rate today to maybe a 4% rate in 6 or 9 months, it's not going to just stop at 4% if they're correct. Mm-hmm. It's heading to 5 or 6. And that means there's going to be other effects happening in the economy if you see that many more people lose jobs.
All right. So let's talk about this then. So, the question I want to ask you is can the economy handle a cost of capital this high? Can it handle interest rates at these levels? Obviously, it sounds like you think that they're going to bring the economy into recession. What do you think is the most likely progression from here? How does the lag effect really begin to manifest from here in your eye? What are you going to be looking for?
Yeah, so one example where I know the last time you interviewed our founding partner, Ted Oakley, he talked about some of the leading indicators that we follow. One of them is watching the change in lending standards by banks around the United States. And those standards, what it takes in order to lend to a small business or a household, they're tightening those standards substantially. And you can go back through decades of history. When they've tightened like this, there's never been a false signal where it didn't lead to a recession. So right now, let's say about a third of lending in the U.S. economy comes from banks. That third is tightening substantially. And then the other 2/3, about say a third of that is private credit, which is actually doing quite well. And I think that's been part of why things have stayed more resilient than expected, that the private credit area was maybe not as built out decades past as it is today. And then the remaining area is that large companies can still go to the public markets and issue debt and try to get some financing that way. But that's not an option for small businesses and households. So we think that sort of slowdown on the small business and household side, that's not going to go away, especially when banks don't really know necessarily what their profitability is. They don't know what their asset level is, considering people are still pulling money out slowly to invest at a higher return in a CD or a 3-month treasury bill, something else that can get them at least a 5% annual return rather than the very slow or small return you'd get at a lot of these banks.
All right, and presumably, I've shown some charts in some previous videos of the corporate debt that's coming up for that's maturing over the next couple of years, and it's a lot. It's like, I don't know, 600 billion or so this year, almost 800 billion next year, over a trillion in 2025. So that's going to be weighing heavily on the corporate side of things, but they've got time, right? And they've got some of the venues that you just mentioned, but small businesses and households don't. So they're probably going to be stumbling first, I imagine, in your timeline here. So we're going to see things like consumer spending, which obviously is 70% of today's economy. That's probably going to start getting injured first as we go along the process here.
Yeah, we think that's right. And then the other area that we look at is within the public markets. It's actually the smaller companies that have a much higher proportion of debt that is sensitive to interest rates, whether that's variable rate debt or short-term debt that's coming due. They didn't raise as much long-term debt at fixed rates like large cap companies. So if you do want to be invested in the stock market, we would suggest staying more in smart areas within large cap stocks rather than small cap, just because the small cap area is way more sensitive to the economic growth rate and is carrying more debt. We actually saw a recent piece of research that showed that for the small cap market at large, next year, a quarter of their EBITDA is going to be put towards just paying interest expenses. Whereas
Wow.
for the large cap companies, it's less than 10% of their EBITDA, since they have stronger balance sheets, and you have a lot of these tech and healthcare businesses that have very little debt anyway.
Wow. Okay, that's a great point. So it sounds like in terms of some things that you're maybe bearish on is things like the Russell and the Wilshire, right, which are filled with much more with the smaller cap companies.
Yeah, we would view the Russell 2000 as a more broad view of the U.S. economic activity as a whole, as opposed to the S&P 500, which is dominated a lot by certain companies in a specific sector. And it's still interesting to us that since that low in the stock market in the fourth quarter of last year, the Russell 2000 really is not appreciated by much, nowhere close to what it normally would off of a great low. So that tells us that there's still some issues going on. Another place to look within that is the regional banks. If you looked up the regional bank index, they fell off a cliff in share price in March when a few of those banks went under. They're still at the same price today as they were 5 or 6 months ago after that fall. And usually, if we're working our way out of a difficult economic environment, the financials and the banks in particular are playing a part in that. They're participating. But in this case, that's not happening, which tells us that this is a different situation that we need to continue to just monitor and be careful with what we're doing.
All right. So I want to start heading into, okay, what you're doing given all this outlook, right? So I'm going to assume you're probably staying away from smaller cap companies. I'm going to assume in general you're not super sanguine on stocks, because given the outlook that you've painted, it sounds like you expect corporate earnings to be getting increasingly weighed upon by the issues that we've talked about here. You're nodding, but I'll let you expound on this. Why don't I let you talk about equities in general, but then of course I want to get over to bonds and interest rates, because I think there's some really interesting things going on there right now.
Sure. So just touch on those couple of points. So for small caps, I think we would look in the small cap market eventually, but not at this point in time when we think economic growth is slowing. One thing just for people to know when it comes to small caps is you really want to be specific about which individual companies you want to own. You want to look for small cap businesses that either have high free cash flow margins or have a high free cash flow yield. And that's going to be your best chance to do well within the small cap market, but you need a better entry point than what you have right now. Stepping that aside, if you just look at stocks in general, you're right. We are being pretty careful in terms of what we select. Going into this year, we had more exposure to cyclicals after the sell-off in 2022. We were buying a lot of the tech positions that we own, a lot of the consumer positions that we own for new stock clients of ours. But those have appreciated by so much that they've gotten ahead of our fair value estimate. So we're kind of not even going near those right now. And we've actually been adding in other areas of the market that are more defensive. And really, I think the focus for people should be on those areas of free cash flow margins or a good free cash flow yield. And in a business that you've got some visibility that the cash flows will be there, even if the economic environment gets worse, because there are certain areas that might optically look like they've got good earnings right now, but if it's a consumer durables business that's selling cars or boats or even like the home builders right now, we wouldn't be putting in at these prices. Those are not areas where you can really bank on the cash flows being able to come through even in a difficult time. So we're really just trying to make sure we map out the downside and try and keep our losses small if there are any, and just pick spots in certain areas.
Okay. All right. So that's the equity side of things. Over on the bond side, really interesting time there, right? You know, we've been talking about how interest rates are high and that's kind of changed the game for everything. But suddenly you can get a good yield on bonds, on safe bonds, which was something that, you know, wasn't the case just a few years ago. And for a long time, it wasn't the case, right? So I'm going to presume in your outlook, you're probably taking advantage of that. I guess how, and how do you look at bonds in general? You know, the attractiveness of, say, U.S. Treasuries versus corporate bonds.
Yeah, you're right. I think one way to look at this is you're always asking yourself when you look across financial markets, is there anything that looks obvious as sort of like a great opportunity that you wouldn't normally find? And in most places right now, there's no amazing opportunity. So it's a lot more nuanced, just trying to make small picks here or there, allocate in little ways. The one that looks to us like a really great opportunity is that you can get a 5.5% annualized return on a 6-month treasury, or close to that for a 3-month treasury. So we actually have our biggest position and the most allocation is in that short-term treasury, and we'll own a little bit out to about the 2-year mark in the treasury. But we probably have anywhere from 4 to 6 times as much exposure to the short-term treasury as we do to long-term bonds right now. We do think it's an interesting spot for long-term bonds, but it's really hard to beat a clear 5.5% expected return with no duration risk, no credit risk. And if you've got that as your opportunity cost, you really are going to have a tough time trying to find something else that you'd want to own. So that's really where our main focus is. We've found some opportunities in long-term municipal bonds that are high quality for a little bit of exposure for our income accounts. And then in terms of beyond that in the bond world, we don't own anything in the corporate bond space, whether it's investment grade or high yield. And the reason for that is just the credit spreads have not widened at all. They're actually, I think, even narrower than average. And that's usually not the time that you'd want to be jumping into that side of the market. So our focus is just taking that 5.5% and then looking for opportunities outside of that that would be even better. But it's a very good place to be to start.
Great. Yeah, and I appreciate you sort of underscoring it. I did this in my conversation with Stephanie Pomboy the other day. It's not all that often where you get kind of like a, I don't want to say slam dunk or no-brainer opportunity, because that's overstating it, but where you just have a clearly superior or attractive investment opportunity. And it sounds like right now, for the combination of risk and return, what you're getting right now on these short-term treasury instruments is just historically rare, and especially since you can sit in them and it can be, you're in safety. Like, that's what's not to like, right? And I got to say, like, I can't tell you how many times last year in 2022, as the markets were grinding downwards, where I heard from people, gosh, if I could just get a 4% return somewhere, that's all I want with my money. I'd be totally happy forever if I could just get 4% on my portfolio. Well, now people can, right, with complete safety. And what's so funny is now some people are kind of grousing because, well, these AI stocks are doing so great. I'm angry I'm not in them. But it's like, well, Jesus, that's that's just an aberrant, potential bubble in process. Here, you're getting actual, decent return with absolute safety. Like, why would you regret that, right? So, anyways, I'm glad you underscored that. The reason why you're sticking away from corporate bonds right now, just to make sure I think I understand your logic correctly, is as long as we're higher for longer, yields are likely to kind of persist at these levels. As the lag effect continues to arrive, recession potentially expresses itself, investors are going to demand a higher yield in corporates for the increased risk that corporates have. And so you expect yields on corporate bonds to go even higher. And then given the inverse relationship between yields and prices, you think that corporate bond prices would go down. And that's really why you're not touching them right now. Do I have that correct?
Yeah, that's right. So just to use high yield bonds as an example, you typically are looking for, let's say, at least a 6% gap as more of a good buy spot between the yield on a high yield corporate bond versus a treasury yield of the same maturity. So when you've already got a 5.5% short-term treasury yield or a 4% 10-year yield, you're probably looking at, you want at least a 10% yield on a junk bond before you'd really get interested, and you're not there at this time. So that's one that I think you'd really want to wait and see more fear in the marketplace, and you would see that spread widen. But as we mentioned before, because these public companies are still attracting interest from buyers in the public market when they do need to issue debt, you're not seeing that credit spread widen. And part of us, we also kind of wonder if the fact that the last time we had a crisis in March of 2020, one of the Fed's ways of trying to help the market was going in and buying junk bond ETFs. Maybe people are assuming they would do that the next time there's a crisis. So they're not even letting the spread widen in the first place, unless there was a real catastrophe that hit the world. So you're just not seeing that same opportunity.
All right. Before we fully move on from bonds, I just want to dig a little bit into your strategy for determining when it may make sense to start going out on duration for at least treasury bonds. If I heard you correctly earlier, I think you said you see opportunity there, but not necessarily right now. What will you be looking at to potentially make the decision that, okay, now's the time to actually start going further out?
Yeah, we own some 20 to 30-year treasury bonds. Say it's about 10% of our portfolio for the income strategies that we manage. But I think we're being more cognizant of the fact that it seems like it's a little bit different time in the bond cycle than what we experienced from the early 1980s through 2020 or 2021. You're starting to see yields move higher. The bonds are acting a bit differently. And we just want to be cautious while we're sort of looking at things in this new environment. So it is possible that yields can move a little bit higher, but the reason why we own them now and think this is a good time to have some exposure to long bonds is that when you're at the end of a Fed rate hike cycle, once the rate hikes are done, and maybe July was the last rate hike, perhaps it's a little bit later in the year in November, that's the last rate hike. But historically, once the rate hikes are done, you will see yields move down in the 10 to 30-year treasury over the course of the next 12 to 18 months. And that's the time that you want to own those long bonds, and you could expect a double-digit total return over that period of time. So it's nice to get the 5.5% up front, but there's no chance for price appreciation. This would be a way to get a little bit of that and then some. If you get what we're expecting, where you have this continued slowdown in economic growth and inflation stays in this sort of contained area, and then you would see long-term bond yields start to move down.
Okay, and so would you move when you first start seeing long-term bonds begin to come down, or is there some sort of economic milestone that you'd be looking for to say, okay, this is when we're going to start, shifting more of our short-term capital to the long term?
We've already got a decent sized position, so we would really need to see the opportunity get significantly better, I think, for us to put even more on that side. We would just view it more as you're about at the level. And I think once you get closer to the end of the year, if you really start to think that the rate hikes are done and rates may stay higher for longer, but they're going to stay at the current level, that would probably be the time to have that position and then just monitor it over the course of the next year or so. And we would expect to start moving in your favor.
Okay. So I guess the last question on this, it doesn't sound like you guys are necessarily planning to go whole hog on the long end of the curve at some point. You've got a position you feel pretty comfortable in. Maybe you'll dribble some more in there, but it doesn't sound like you're waiting to put 20% more of your portfolio in that direction.
No, we're not. I think we can go a little bit higher, but we've got a lot of the position that we'd like at this point in time. And so we'll continue to monitor it. But I think really what we see, that short-term treasury money that we have allocated there, we would see that being more of a source of funds for purchases in the riskier side of the financial markets once you see more of a pullback in those areas. So there might be opportunities in common stocks, in energy, and REITs, and preferred stocks. There's a lot of asset classes we look to for income, and there's going to be better entry points, and that's where that short-term treasury money could end up going.
Okay, great. Thanks for revealing that strategy. And folks, I love having folks who manage money on the program because you get to see how their mind thinks. He's getting the yield right now, off those instruments because it's risk-free, high yield right now, but it's not a permanent position for him. He's looking at that as a war chest to be able to then tap when valuations are better in other assets. I want to talk about that in just a second. Just real quick, I do believe you guys invest some in preferreds there at Oxbow. Can you just talk about what you look for in a preferred right now?
Yeah, our focus in preferred stocks right now is really just in the too big to fail banks. And right now, because you've seen this increase in U.S. Treasury yields, you can actually get preferred stocks with a 6.5% or 7% or even higher interest rate or coupon rate that you can receive. And we really focused on those 4 too big to fail banks. So Bank of America, Citigroup, JP Morgan Chase, and Wells Fargo, because those are actually the banks that are gaining in deposits and getting stronger over time. We would expect them to be able to withstand any sort of poor economic environment, continue paying those coupons to the preferred stockholders, and be a decent place to be. So right now, I think that's the only exposure we have at this time. But if you saw a greater sell-off for risk assets, there would be more preferred stocks as well as convertible preferred stocks where you could see some great opportunities.
Okay, and it's a seemingly compelling argument there, which is you can get a higher rate than you can on a treasury on a preferred from like a JP Morgan. And look, if JP Morgan is defaulting on their preferreds, we all have much bigger problems, right? Like that's a world where the economy is like not working anymore.
Yeah. So that Jamie Dimon didn't see it coming, then we're all in trouble.
Yeah. All right. So when I've talked to Ted, he has the wisdom of a career that's been spanned decades in managing money in the markets, and talks about how all bear markets end with a washout, right? They end with capitulation, where really nobody wants to touch bear market equities. Nobody wants to touch a stock again at the end of it. And of course, that's sort of where the experienced people really start looking to buy, right? That's sort of that psychological milestone they're looking for. Despite how painful 2022 was for a lot of people, by no means did we even come close to that kind of capitulation. And obviously here in 2023, everyone's trying to get the party reinvigorated again. So when you sort of referenced your war chest there, and you tell us about your confidence that a recession is coming, are you kind of expecting to have the ability at some point in the next, say, 12 to 24 months, where you will see that capitulation and be able to take advantage of it with the war chest of relatively safe capital that you're building up right now? Is that kind of the plan, the plan A, which is we think we're going to have this opportunity where enough investors get washed out that great value gets just left there on the ground for us to come pick up at great prices?
Yeah, we would say that's what we would expect. There's always the possibility that it takes longer than you anticipate, but you can go back through decades, and usually once every 4 to 5 years, you get a great buying opportunity in the stock market and in some other asset classes as well. And it helps to have some money that's safe and ready to go. And right now you can get 5.5% on that safe money, which is fantastic, and really be able to buy in at fantastic valuations. The last two times we did this were 2 days before Christmas in 2018, right before that low. I clearly remember us putting a significant amount to work. And then March 16th of 2020, which happened to be a week before the low, Ted and I put a significant amount to work. So I think that's something that we're always looking for. And there are certain clear signs that you just know these are the types of prices we want to pay. This is the level of fear in the marketplace that is suggestive to us that it's a good time to buy and to try and take advantage. Right now, we're not seeing those valuations yet. And if you look at the VIX still below 20 as a sign of fear, you're not seeing that kind of fear yet. But if you keep rates this high and you see things deteriorate, any sort of a shock, or like you said, any additional stone on the backs of households or small businesses, could end up being something that makes things more difficult and leads to that fear generating. And then anyone who is ready for it can take advantage.
All right. Well, Chance, let's make a deal here, which is when we get to that moment, whenever it is, when you start seeing those signs that this is the time to start deploying capital like that, let's have you back on the channel. Let's have this conversation again. Let's have you, tell folks what you're looking at and what you're most interested in. So 2 questions for you as we wrap this up, Chance. This has been a great discussion. Thanks for giving us so much of your time and opening your the window so much to your portfolio management. I know when that time arrives, so much of your decision making is going to be driven by just what the valuations are at that moment in the different asset classes there. But what are you looking towards with an eye that when valuations make more sense? Like, what assets are you excited to buy that you're not buying right now?
Sure. Let's go step by step. So in the stock market, there will be cyclical sectors that will have sold off more, and you'll see really depressed valuations, maybe even trough earnings. And we like to look out about 5 years, and it'll be easy to project very high quality businesses that you have a reasonable idea of what the cash flows will be 3 to 5 years into the future. And if you can buy that at a cheap price, that could be consumer discretionary, could be some tech businesses, financials, industrials, energy, materials, all those more cyclical areas. You'll be wanting to rotate out of healthcare, consumer staples, anything that's more defensive, and move towards the cyclical areas of the market. So that's the stock market. On anybody who's trying to generate high income, there'll be areas within energy that you'll see an opportunity. That happened last time in 2020. There'll be areas within real estate that might have sold off that you might be able to buy some REITs. The convertible preferred stocks, there's usually some companies that issued convertible preferred stocks so they could maintain an investment grade credit rating. And if their common stock prices come down, you usually can buy that at a great yield, and then it'll convert into a common stock, and you kind of get a double benefit over a multi-year time horizon. There also might be some other opportunities within common stocks with high dividend paying assets. So we always are monitoring for companies that pay a 4% dividend yield or higher, or a 6% dividend yield or higher. You'll see some of those sell off, even though the businesses remain strong and may have relatively gained market share versus their peers. And that would be a good place to look as well. So depends on what your goal is, but there will be opportunities across a lot of different fronts.
All right. Well, let's hope that opportunity arrives sooner rather than later. I'm getting really tired about talking about all the warning signs on the macroeconomic side of things and preaching safety, and would love to get to the point of the story where we get to talk about great valuations and great entry points for people. Last question on this, which is, are there any other assets that you guys are holding or buying right now that we haven't talked about yet? I'll toss out some candidates just because they come up relatively frequently on this program. Gold is one. Energy is another one. I know you just hit energy in your previous answer, but some people are actively buying some energy companies right now, given the attractiveness of that, relative attractiveness of that sector. But are there any assets that are worth noting that we haven't touched on yet?
Yeah, I think first, just to touch on the energy, we do own some energy assets in our income strategy, and that focus is more on the what we would consider defensive part within the energy sector. So the pipelines, which are in about as strong a fundamental position as they've been in their history. They've paid down a lot of their debt. They generate a lot more cash flow beyond what they pay in dividends, which they pay a good dividend yield, somewhere between 6 and 10%, depending on which ones you own. But we own some of those pipeline businesses, and then also own an oil royalty business. That's just a very high quality business model because they don't have the same expense base they have to deal with as if you were an actual driller for oil. Mm-hmm. On the gold side, we do keep some exposure to actual gold, and then to a few high quality gold royalty or gold miners. And that's been something that we've had in the portfolio for several years. And we think that's just a good place to be, to try and maintain and grow purchasing power in a way that's diversified from the rest of the portfolio.
All right. Well, look, Chance, we'll have to end it here, but just a wonderful conversation. Again, thank you for being so transparent. It's really valuable when I can bring on a capital manager like you who just walks people through, the logic in their head of why they're making the decisions they are, or as you've done here, you've detailed the playbook for the strategy you're going to use once the buying conditions come into play. So thank you again for being so generous with that. For folks that have really enjoyed this conversation and would like to follow you in your work, where should they go?
Yeah, you can learn more about us at oxbowadvisors.com or visit our YouTube channel under the label Oxbow Advisors.
Okay, so if folks are looking to stay on top of your work, go to the website. Also, I know that you guys do interviews sort of like this on YouTube periodically, and folks can see you in conversation with other people in this space, correct?
Yeah, I think the YouTube channel is a great place to go. We try to post something at least once a month, providing a little bit of our view on what's happening in the marketplace. And then we also like to do interviews of other professionals that we respect a lot in the industry, and just have a good dialogue going of all the things that we think are valuable to know about how to invest your money.
Great. All right. And folks, as I said in the intro, Oxbow, their main focus is high net worth individuals. They kind of specialize in the entrepreneur who had a big liquidity event, sold their business, sitting on a big pile of cash, doesn't know necessarily what to do with the cash, and maybe even necessarily what to do with themselves now that they've handed their reason for being over to somebody else. So if you fall in that category, definitely give the guys from Oxbow a shout. But for all of the macro issues that Chance and I talked about here, it should be self-evident at this point, but this is why we recommend that, the vast majority of people who view this channel should be navigating what's ahead under the guidance of a good financial advisor who understands all these macro issues. If you are, and if you're not a high net worth account like I just mentioned, or an entrepreneur who just sold their business, if you don't have a good advisor who's advising you, consider talking to one of the financial advisors that Wealthion endorses. To do that, just fill out the short form at wealthion.com. These consultations are totally free. There's no commitment to work with these guys. It's just a free public service they offer to help as many people as position as prudently as possible in advance of the developments that Chance referred to here. And if you'd like to see Chance back on this program again in the future, especially when he starts seeing the indicators that tell him it's starting to be time to look at buying things, do me a favor, voice your support for that by hitting the like button and then clicking on the red subscribe button below, as well as that little bell icon right next to it. Chance, again, it's been a wonderful hour. Thank you so much for your time. Any parting bits of wisdom for folks as we wrap things up here?
No, I think just continue to be mindful of the environment, and just be prudent with what you're doing. There'll be great opportunities down the road, but right now it just pays to just stay on top of what you have.
All right, Chance, thanks so much again. Everyone else, thanks so much for watching.